Hi, my name is John Stevenson, and welcome to the Guaranteed Retirement Guys show. Today, we're going to be talking about how to never run out of money during your retirement. So this is a pretty tall order, right? A lot of us are wondering, well, how do I not run out of money in retirement? I just retired, or I'm about to, and I think I have enough money, but I'm not sure. And I'm thinking about taking a safe withdrawal rate of 4 or 5%. But if the market doesn't deliver me this, I probably won't last till I'm, maybe 80 or 85. And then hopefully I'll be dead by then, right? That's not a great way to think. And most of us don't want to think like that. We want to be able to live as long as possible and be able to make sure that we have that income that never runs out. Okay. So I say income. Again, the name of this video was how to never run out of money during retirement, not income. Okay. But most people will associate it with income. So I'm going to talk about both. Okay. Because really that's the most important thing, right? You want to make sure your income never runs out. But if it's money, we'll talk about that as well. Maybe you want your nest egg to stay where it is and you want to leave it behind to someone else, maybe a charity, your kids, grandkids, whoever. Okay. We'll talk about that. Okay. Because you can do that. But we're also going to be talking about the income side, how to never run out of income during retirement, because that, again, is a form of answering the question, how to never run out of money. Okay. So again, my name's John, and I am the Guaranteed Retirement Guy because I talk about guarantees. I talk about contractual guarantees offered by insurance companies, and they do this through annuity contracts. Okay. Annuity contracts have been around for about 500 years, so they're not old. Okay. And when you're looking to put money into one of these, you want to work with a company that's been around for a long time and who has a very high rating, especially if your premiums are high. Okay. So otherwise you're going to spread it out through different annuity contracts. But these are very, very effective for stacking your income and making sure that you have contractual lifetime income. So if you live to 110, your money continues. And the nice thing is it continues regardless if you are, mentally there, right? So if you're not as mentally sharp at that age as you were when you were 50, okay, it doesn't matter. And if you die and your spouse needs that income, it will continue to them. They don't have to think about it, okay? A lot of times we think, well, I'm really good at generating income right now. I'm generating income or money or whatever, okay? But you might not be so good at it when you're 90 or even interested in it. And so with annuity contracts, they provide that income for you so you don't have to think about it in your later years, okay? It could be a huge blessing for you and your spouse, okay? So I'm going to share my screen and I'm going to show you what this looks like. Okay, so again, we're looking at, in this particular example, not running out of income during retirement. We'll talk about money, and I'll tell you right now, this contract will run out of money, but it will not run out of income. Okay, so the income is guaranteed contractually. So in this example, I'm using someone who is 63 and they want to wait 4 years to take income. They want to take income at age 67 because maybe that's their full retirement age, and that's when they want to take Social Security and they want to take extra income from an annuity contract. So $300,000 does not represent all of their money. They might have $500,000, but they only want to use a portion to cover their income, which is a perfect way to do it. So $300,000, and again, this is a single payout. If it was a joint, it would be a little bit less depending on the age of the spouse. Okay, but then it'll be guaranteed for the spouse's life as well. And this is important because the money does run out in this account eventually, but the income does not. Okay, so if we look at this, we'll say, all right, well, which companies are the best? We got F&G, which is Fidelity and Guarantee. You got Corbridge Financial. They've been around for 100 years. You got Equitrust, good company. Athene, 100 years. And A+. Then you got American Equity. They've been around for a while and they're A-rated and so on. There's just a lot of companies and they're good companies. Okay. So, but let's look at the highest payout because the highest payout happens to be with a strong company, F&G A-rated, and the payout is almost $31,000 a year guaranteed for the rest of your life. That's great. So we'll look at that and say, okay, so if I take income in 4 years, you can see the payout here. Let's see, $30,000, and you'll notice that the balance here does not last. See, it does not last. It lasts to like 77, but the income lasts. And you'll notice if you're alive at 95, you've taken out $900,000. So you've taken out 3 times the amount. But remember, this is contractual income. This is for peace of mind. So if you live to 100, which more and more people are living that long or longer, you're going to continue to take income. 5 years, it's another $150,000. Now you crossed over the million mark. Okay. This is important to know because when you're looking for longevity risk protection and you don't want to run out of income, okay, this is what does it for you. So, but you'll notice this account does run out of money. So I'm going to show you something else where it does not run out of money, okay? So there are different strategies that you can use, okay? And I'll go right back here and I'll show you, all right, well, what if you're married? Okay, we'll just kind of do an example here just because we've looked at the single payout. What's the joint payout? Okay, and I'm just going to say the spouse is 63 as well. So the income's a little bit less. It's $28,341. So it's about, you're taking $2,000 subtraction from your annual income. That's not too bad, but now it's guaranteed for your spouse's life. So when that money runs out in that account and you die in, let's say, 15 years, hopefully not, but if you do die early, that income will continue to your spouse regardless of the account balance. This is a contractual agreement. That's what it's for. It's for pension income. Okay. So that's with Corebridge. Athene is right below them. It's $27,840 and American Equity. So some of these work better for single payouts. Some of them work better for joint payouts. So just remember that. All right. So I'm going to go right back to the single payout. Okay. And then I'm going to look at maybe also not running out of money, but also having income that lasts a lifetime as well. Okay. So I'm just going to go here and I'll say, you know what? I don't want to pay any rider fees because these income riders is what gives me this high income. Okay. I don't want my account balance to be depleted by these rider fees. Okay. So you can still get guaranteed income, but it's quite a bit less. It's like $20,577. So you're just basically taking less of the contractual guarantee that the insurance company has to give you. So instead of $30,000, it's $20,000. So let's look at the account balance now. So we look at the account balance, and again, they'll show you two scenarios. They'll show you if the S&P 500 doesn't deliver any growth, which is, in my opinion, ludicrous, but let's say it doesn't, then the account balance will just go down faster. And eventually it'll be zeroed out by the time you're 84, 85. So you notice the account value lasts like 10 years longer, okay? Even with no growth. But again, that's with no growth, okay? And you can see the income is guaranteed, doesn't change, still there forever, okay? Now let's look at what the index has done over the past. You'll notice the growth rate, you're still getting the same income, but you notice the account value lasts a whole lot longer. In fact, it lasts till you're 90. So if you're looking to keep that money around longer, if you're thinking, well, I'm going to die in my 80s, I'd like to leave something behind. You die at 86, 87, you're leaving $96,000 behind, okay? That's the difference. The difference is you've got less income and you've got more money to leave behind, okay? So anyways, you'll never run out of income. The income's just cut down quite a bit. Instead of 30 grand, it's 20 grand. Most people do not want this. Most people are willing to pay an extra $50,000 in lifetime fees in order to get an extra 400 or 500 grand in income. Okay. It's usually a good trade-off, but that's if you're looking for income. Okay. And again, I know the purpose of this video is also to share with you how to not run out of money in retirement. So what you would do with that is you can go into, I'll show you one other example. You can go into one of these contracts. This is a MYGA contract. MYGAs are multi-year guaranteed annuities. They're just like CDs. But they're annuities, and they're better in my opinion. They got better rates, and with non-qualified money, you can still have tax-deferred growth, whereas with a CD, you have to pay taxes every year. But the downside with these is it's not guaranteed for life. It's guaranteed for a period. You see, this is showing all the top 3 options for the different periods. Okay, you see 3 years, 4 years, 5 years, and so on. So if we go down and let's say 10 years, I want to do it for 5.55. Okay. Well, the first year I can't take any money out. There's no free withdrawal amount, okay, unless you want to surrender it and pay surrender charges, but you don't want to do that. Okay, so if you did that though, let's say after that you wanted to take money out. You want to live off of it, but you don't want your money to run out. You don't want, let's say you want your principal to stay the same. Okay, you just want to live off the interest. I'll show you what that will look like. So $300,000, you'll notice the income here is $16,650. So 300 grand times 5.55 equals $16,650. You take that out every single year, that's what you've got. And that will be guaranteed for 10 years, okay? You notice the earnings go up over time if you let it compound, okay? So that's the power of compounding. By the last year, your account balance is like $487,000 times 5.55 gives you $27,000 that last year, okay? But that's if you let it compound. If you're just doing it for income and you want to make sure that money does not run out, then just take the $16,650, and then at the end of that, roll that $300,000 into something else. Maybe you can roll it into another annuity contract for 10 years, one of these contracts. But if rates are low, you might not want to do that because income's going to be a lot lower, right? And then you're going to have to find something else. And if you're looking for higher income, you're going to have to maybe roll it into an income product like I was showing you before. The problem is if you don't have that time for deferral and growth, the income might not be as high as what it could have been had you put it in an income product in the beginning. So that's why when people meet with me, I usually ask them this question: what is the purpose of your money? Do you want it for growth? Do you want it for income? Do you want to leave legacy behind or not? Okay. And usually people say, no, I don't want to leave legacy behind. I've got my house and I got my other assets. I can have that. I need this for income. And that's fine. That's what people use these retirement accounts for. And so, but you notice the income is $16,650. All right. That's, it's not very much, right? It's not enough. And let's say you were to defer it, right? Let's say we deferred it 4 years. Okay. If you deferred it 4 years, you take an income of like $19,579. That's not bad, right? You're taking that out and your account balance is like $352 at that point. Still, at the end of that 7 years or 6 years, you take an income $19,579. At the end of that period, you got $352,000. You roll it into something else for income. You have to remember that most times, and I can do this calculation with you. If you book a call, we'll do this calculation. Most of the time, the income is far less than if you just had put it into an income product right at the beginning. So again, you have to ask yourself, why do you want this growth? Do you really care if your money runs out? Or is it more about, do you care if your income runs out? Okay. And both of those are completely separate questions. One of them is really for legacy, because if you don't want your money to run out, then you want to leave it behind to someone. So it's not for you. Okay. But if it's for you, then you really need to think about income and where can you get the highest contractual income for your money? Okay. Where can you leverage it the most to give you the most guaranteed contractual income? Okay. So that's what we did in this video. We looked at kind of both of those options. I hope that answered your question. If you have further questions, comment below this video. There is a comment section. If you like it, make sure you click the like button, subscribe, share, so you can get all of my awesome content. And of course, if you want to book a call, book a call. Okay. Link below this video. There's a link on my website, johnstevenson.com. There's calculators there as well. If you want to go on there and kind of figure out what the income could be for you in these contractual payouts. The income rider is the highest payout. And then you got SPIA, DIA, and QLAC for other scenarios that you can use as well. And then of course you got the MYGA, which we just went over. You can look at those rates as well. So, and then you can book a call if you want to. But anyways, I'd love to sell you an annuity. And if that's what you're looking for, I'd love to earn your business. And again, if you book a call, I'm not going to try to sell you. I'm going to just educate and show you what's available. And then you can kind of decide, look at it and decide what you want to do. Okay. It's not going to be a pushy sales call. Okay. I hate that. I know you hate that. And that's not what that's going to be about. Okay. So anyways, hope you found value. I appreciate you watching. And we'll see you next time.